So, the US Federal Reserve has cut interest rates for the first time this year. It was widely anticipated. So now the range sits at 4% to 4.25%. And that's not all. Fed Chair Jerome Powell signaled 2 more rate cuts for the rest of this year. Not a lot of months left to the end of this year if you think about it. But what does it mean for you and your investments, especially US holdings? I'm Andrea Heng, and today on Money Talks, we're going to get that question and more answered. And to help with that is Ritesh Ganeriwal, Managing Director and Head of Investment and Advisory at investment platform Syfe. Hello, Ritesh.
Hello, Andrea. Pleasure to be here.
It is a pleasure to have you in the hot seat. I hope it's not too warm.
Very good.
So, Ritesh, I bet you had anticipated, like the rest of us, that Fed rate cut. What was the first thing that went through your mind when the 25 basis point cut was announced?
Yeah, so the 25 basis points cut itself was very much priced in by the market. So that was no surprise at all. And what everyone was looking forward to was what's the guidance that the Fed gives, as we move ahead. And that's where I think things got very interesting, because on one side, there is a guidance for 2 more rate cuts for the end of this year. But in 2026, there is only 1 rate cut projected. But the bigger things in between lines is the divergence that is emerging within the Fed. And that is very interesting because there is a dovish start, but a very hawkish kind of a finish. Which I think the market is not buying into.
Okay.
Because if you look at 2026 and Powell's term is due to end, and how the Fed, gets reshaped, its independence is also kind of like a bit in question. And the market is actually pricing in 3 more rate cuts into 2026. And that sets the stage for what's going to happen in terms of asset classes as we move forward,
right,
as well as the US dollar.
So what does this rate cut and the projection tell you in terms of the signals that the US is trying to send out, and why should it matter to us?
If you think about the Fed current interest rate decision, the short term is now projected to be around 3.5% by the end of next year, right? And while it makes the short end of the curve come down, the longer end of the curve is still very, very anchored. And that's really making the yield curve kind of like steepen through. More importantly, this also has implications in terms of not just fixed income, but also the US dollar. And especially for investors who are international and in Singapore and outside, the US dollar weakening has been one of the biggest macro stories for the first half of this year. And now it had a brief pause, but as we move forward with the interest rate cycle re-emerging to be cut going forward, the US dollar can continue that weakening cycle as well.
Yeah, that's going to be very interesting moving forward. Now, let's get into the nitty-gritty of this conversation, Ritesh. Something I noticed was something that happened in the Russell 2000 index. It rallied to record highs when this rate cut was announced. For the listener, the Russell 2000 index is basically a small cap stock market index. In the US, it tracks 2,000 of the smallest stocks in the US, and you're looking at things like Duolingo, Elf Beauty, Coke, Abercrombie and Fitch, lots of pharmaceuticals, biotech, and downstream AI stocks in there. So, Ritesh, the big question is, do those of us with US stocks, should we start recalibrating our portfolio and include small cap stocks now?
That's a great question. Now, the interesting thing about the small caps is the fact that how they are sensitive to the interest rate changes as we move forward. And in that, what is important to note is in the small cap world, 35% of such companies have floating rate interests.
Okay.
Right? In terms of the debt that they take, versus an average of 7% in the S&P 500. What that means is when you think about an interest rate regime that is, going down, that will have a much more favorable impact to the small cap stocks. Also, from a valuation perspective, if you look at the profit-generating part of the small caps and the mid caps, they trade at a discount compared to the large caps.
That's right.
So if you put all of these together, there is definitely a much more favorable outlook for the small caps as we move forward.
Okay, so diversification, you can include some small caps if you wanted to at this juncture.
Yes.
Okay, so something you talked about earlier, fixed income assets, that's going to be hit, no doubt, by these lower interest rates. We're talking about bonds, stuff like that. They hinge on interest rates. And with a cut, obviously, it means a lower yield on things like low-risk investments. So we have a lot of low-risk investors here in Singapore. We're quite conservative. What do or should low-risk investors do if they feel pressured to look elsewhere for reasonable yields? Do we ditch fixed deposits? But what else is there if we ditch fixed deposits, right?
It's certainly very hard juncture for fixed deposit holders. And if you look at the Singapore interest rates, they have come down much ahead of the US interest rates as well. And inflation is still, decently high. I think overall from a core inflation standpoint and growth standpoint, overall the Singapore economy is much more robust and inflation is still, very much under control. But if you think about long term, investors who are happily generating 3+%, returns in fixed deposits no longer are able to do so.
Exactly.
And there is this big reinvestment risk. So obviously they need to go beyond, the fixed deposit regime. The few options are, if you want to take slightly higher risk, you have money market instruments where you can get around the 2% mark. Still, not enough, I would say. But the good news in Singapore is that we have a robust ecosystem of REITs as well as Singapore banks where the yields are decently high. Singapore REITs are currently at 6% dividend yield. The Singapore big banks, the DBS, OCBC, UOB, you can easily generate 5% there as well.
Okay.
So these are definitely very interesting opportunities that are presenting themselves and at a meaningful, spread above the base rate of 1.5%.
Okay, so maybe it's time for us to support local in a way.
Yes, and if you think about it from a policy standpoint as well, there is a lot of policy support that is coming in. So the MAS has also kickstarted what is called as this EQDP program, where they're going to allocate $5 billion to the Singapore equity market. And part of that allocation will also go towards the mid-cap and the small-cap sectors of the Singapore equity market. So that basically means as an overall ecosystem, the Singapore market does look much more attractive. And if you're thinking about, again, your allocation of new money, and if US dollar returns are going to be impacted due to the currency coming down, you have to either hedge your exposure, which goes outside of the US, because, the allure of the US market is still pretty high, I would say. The AI investment story still remains very, very intact. And you would want to diversify, within that context. But you do want some of that US dollar exposure, probably in a hedged manner. But when you look at other avenues for you to generate returns, then obviously, beyond the very safe instruments, you have to dial up the risk a little bit and take exposure to the REITs market, to the banking stocks. REITs particularly, I think it's a very favorable environment. Again, we have had a pretty challenging time frame for the REITs over the last 3-4 years. And it's been impacted first by COVID, then interest rate hikes, etc. Now we are definitely looking at a much more brighter outlook for REITs. They have rallied close to 15% in the last 3 months, in fact.
Yeah, I remember a time when REITs were really in the doldrums, especially during COVID and even coming out of COVID. It really struggled to a sputtering start. So all of this involves, like you said, taking on more risk, right? You need to take the risk in order to venture out. And the thing is, the current environment is especially volatile. We don't know what's going to come out of the US, for example. How do we manage this while we are already diversified? It's a big question.
It's a big question. But look, I think if you think about where we are headed as we move forward, we can also take this as an opportunity to take positions which would help us navigate through these uncertain and potentially risky, volatile environment as we move forward. Typically, when you go back in time and evaluate the different rate cutting cycles, they in general favor emerging market equities compared to the more US-centric equity market. So if you're thinking about diversification, think about diversification not just within the US context, but also, geographically and globally. And what that means is you definitely need that emerging market exposure, that developed market ex-US exposure. In fact, for the last 1 decade, this is the first time that you're seeing the emerging market and the developed market ex-US outperforming the US market on a US dollar basis. But even without currency, you're seeing the China market rallying, more than 30-40% in this year. And obviously in the European and the broader developed market region as well, you're seeing all of that rally panning out as well. And history suggests that whenever the rate cuts happen and the narrowing interest rate differentials do have a favorable, impact on emerging market equities.
So even with a weakening US dollar that is set to weaken even further after these rate cuts going into 2026, those US dollar trades in emerging markets still have a place?
Absolutely. And look, I think within the US, just was reading the previous week, there has been a big surge in flows in the US on a hedged basis.
Right.
So more than 80% of the US equity flows are now going on a hedged basis, more than 50% on the fixed income side. And that just tells you the story that people still want that US exposure. So they're diversifying, yes, but they're also hedging that currency risk that is due to come in as we move forward.
Okay.
And then if you create a portfolio that has that US, dollar hedged to a certain extent, you have your emerging market exposure. Similarly, we are actually pretty constructive when it comes to fixed income and high quality fixed income. So while interest rates are coming down, what that also means is the bond prices will go up. And that is very good for investors who are, in that income kind of allocation.
Okay.
Because overall, from a portfolio standpoint, then you have that equity piece. But on the fixed income side, that helps you reduce your risk and also, get that participation, not just from a coupon standpoint, but also from a price appreciation standpoint.
Right. So does that mean then we should not immediately eliminate any bond holdings and stuff like that from our portfolio? Not just
Not
yet.
at all. In fact, this is actually a great time where you're getting equity-like returns from fixed income.
Okay.
So as I said, you're getting double benefit. You're getting the benefit of the high, income that you're generating from fixed income and bonds. But at the same time, you're going to benefit from the interest rate cut, which will translate into bond prices moving up.
Correct.
If you're thinking about, again, risks on the horizon and, hedging aspects, we also have a pretty decent position in gold. And gold has been that other asset class which has continued to just shine and shine.
It has been phenomenal to the
Yes.
point where people are asking, how do I even buy gold if I feel like I'm being priced out?
Actually, if you think about, again, the interest rate cycle moving forward, the bond prices may continue rallying. And there is a lot of institutional and even central banks interest in terms of buying gold that has really helped. And gold as a safe haven asset, if you're talking about all the geopolitics and the war still ongoing, then you would want to have gold as part of your asset allocation. And as the US dollar weakens, gold again, becomes much more valuable from that perspective
It's
as well.
flight to safety. That's what they call gold. Okay, so let's bring things back here home to Singapore, Ritesh. Our own central bank, the MAS, has eased monetary policy in January and April this year. Nothing since then. So how might the US rate cut influence what happens here? Because from what I understand, a lot of other central banks around the world have sort of stopped aligning themselves with the US central bank in terms of, interest rate policy. So how might that affect the MAS?
Yeah. So in the first two meetings, which is what you said, January and April, MAS did ease the monetary policy. And this was an environment where, again, there was, the tariff-related impact, the Liberation Day, and before that, there were also still a lot of concerns about inflation running hot and growth potentially coming, slowly as we move forward. Fast forward in July, the reality of the Singapore market is actually much, much stronger. And the growth is much above 4% in terms of GDP. And core inflation is still much lower than 1%. That gives MAS a lot of room to, remain where it is in terms of the policy band. But what it means is, from an interest rate standpoint, the Singapore interest rates had already come off quite meaningfully.
That's right.
Compared to the US market. And this has really been the story, not just in the Singapore context, but also about the more other global central banks. They have been much more proactive about reducing interest rates and having a more easing monetary policy, again, at the backdrop of a much stronger economic cycle. What this also means is going forward, there is no need for the central banks to cut so aggressively, right? And what that also translates into, again, is the narrowing rate differential that I talked to you about. And translating into that US dollar weakness as well.
Very interesting to see this divergence happening now. It's something that I think we can no longer predict almost, right? So obviously lower interest rates make it cheaper for businesses to borrow. But are Singapore companies likely to actually invest more now that, rates are lower, the US dollar has come down? Or will they just hold back given the uncertain global outlook? It's a toughie, this one.
Yeah, look, I think overall, again, the growth aspect of Singapore is still very strong. And when you look at it from a policy standpoint and the kind of, infusion of capital that is coming in within Singapore context, I do see the capital allocation and investment continued to go up. If you look at specific sectors like technology and all, data centers, etc., these continue to have huge, pouring of investments, which I don't think will, pare down anytime soon. So I do have a very, positive outlook when it comes to capital expenditure, and especially in these high growth sectors, which bodes very well for investors. More locally, I think the Singapore STI index is up close to 14% year to date. And the REITs market, banking stocks, they have also benefited quite well.
So there are 2 more expected rate cuts from the Fed this year, plus 1 more in 2026 so far. But how long before us, the Singapore homeowners, feel the pain in terms of the floating rate mortgages that we might have, right? In our monthly repayments, when do we start feeling this?
In fact, it's a great setup. Actually, as I said earlier, the Singapore interest rates have come down much ahead of the US interest rates. And what that means is the mortgage rates, I think, are below 2% at this stage, which is already really, really good for Singaporean investors, right? So I think overall, it comes down again to the savings aspect and where you are allocating your money, which was previously in fixed deposits and very safe instruments and was generating you pretty decent returns. That is the flip side of it, because that money needs to be now reinvested. And if you put it back into an FD at 1.3, 1.4%, that's not good enough.
Yeah.
And that's where, in terms of looking forward for a Singaporean investor, it is important that you diversify beyond and you take risk, but take risk opportunistically. You take risk in a calibrated manner. When it comes to fixed income, as I said, the interest rate regime as we move forward is actually much more favorable. And if you can hedge your kind of like dollar exposures, that positions you really well to get a higher yield on your cash rather than sitting idle and generating very little interest.
Okay, and what about the consumer dollar? We import a lot of our food. We import a lot of things from the US as well, one of our biggest trading partners. I mean, does that mean cheaper items are going to make their way into the grocery aisle, or will the effects be too small to notice? I mean, this is on the minds of a lot of Singaporeans.
Yeah, it's interesting. Look, I don't have a crystal ball here, but
Sure.
I think overall, if exports to the US are going more and more expensive because of the tariffs, where else, do the exporters look at? And from that perspective, the rest of the world will probably see a lesser impact in terms of prices compared to US itself from an inflationary standpoint. Because if US exports are, going to come down for a lot of the export-oriented economies, they will look at other jurisdictions where they can also, pair that risk and reallocate some of those exports. And from that perspective, we should actually benefit.
Yeah. Southeast Asia as a whole will benefit as well, right?
Yes.
Okay. Well, a clear understanding of what the US rate cut will mean for our holdings both here and in the US. Thanks very much, Ritesh, for laying this all out for us.
Thanks. Pleasure to be here again.
Yeah. To the Money Talks community, if you've got any messages, comments, or questions, you can always leave us a message. Money Talks is available on Apple Podcasts, Spotify, YouTube, and Me Listen. Do leave us a rating. The team deserves some credit. Tiffany Ang, Nat Fetavero, Junaini Johari, Joanne Chan, Hanida Amin, and Sayu Wind. I'm Andrea Heng, signing off for the Money Talks podcast.